second. Okay. Abdurrahman Fadilet is here.
I'm here.
Okay. Tengir, Aynur,
Here.
Raushan, Bernard, Mamet, Sanjar is here.
Bejan is here.
Bekjan, you're here. Okay. Sanjar is here as well. Alua.
Here.
Okay. Dongo.
Here.
Okay. Aidana. Almat. Raj is here.
Russia.
Ademi here. Begzat.
Here.
Camila.
Here.
Daulet. Ruslan. Yıldız.
I'm here.
Marjan. Okay. Okay. So on Monday, we started chapter 8, and which we discussed actually using the Stata program. Concerning the Stata, I showed you some regression analysis. We created some models like profitability models, and we said what we tried to measure what some factors, how they affect the profitability. And we said the main profitability of the banks is through the interest. So interest rate risk. So we stated that if the interest rate changes, that changes will affect the bank net interest income on loans and securities as well. And it will affect definitely the interest cost on the deposits and some other borrowings of the banks. So change in interest rate will also to change the market value of the bank's assets and liability, because the size, the assets of the banks is mainly based on the interest. We said the loanable fund theory is showing the interest rate determination views with the level of interest rate financial markets as resulted from the factors that affect the supply and demand. For the loanable funds, I introduced some curve like demand for loanable funds and the supply of the loanable funds. I introduced you as well the monetary policy, said that why we need to have the monetary policy to make the economy work better and smooth, and to stimulate the demand if there is a reduction in the demand, because the reduce in the demand for goods and services will cause the GDP fall down. And of course, GDP falls down because of the supply reduced and unemployment rises and the recession take the place. If the GDP is down by 3 times in a year, like it's measured quarterly, if it 3 times declare that there is a reduction in the GDP, then officially the country can declare that there is a recession in the country. So Fed monetary policy has got, actually not only the Fed, all the central banks has got 3 instruments that are used to affect the economy positively. So to put the economy into a stable level, we can say so. There are 3 levels: open market operation, the discount rate, and the reserve required ratio. So we said the open market operation is when you're selling and buying the securities, the government securities. When you sell the securities to the market as a government, you sell it, you take the money out. there's economy and there's a money in the economy, okay? If you want to sell, the security, you get the money and you put the security inside the market. So that means you're reducing the money supply. You're reducing loanable funds. If the opposite, you buy the securities from the market, you put into the market the money, you just pump up the market with money, you just increase the money supply. And this is how it works. However, the government, they should be very careful about using the money, like in terms of money supply, reducing and increasing. Too much money in the economy will create what?
Inflation.
Inflation. And too less money will create
Deflation.
deflation. So it's just opposite. So the government should be very careful not to put a lot of money into economy and not to get all of the money and leave the market with nothing. We said that this is demand, this is supply of the loanable funds. Supply represents the banks, financial institution, or any other individuals who lend the money, who has got the excess of money and they want to lend it. And demand for the money are those who are looking for money. Specifically, they are the borrowers. So the effect of the interest rate from shift in the demand curve for the supply curve of the loanable funds, okay? If increasing the supply of the loanable funds, as you can see, what happens to the interest rate, okay? So this is given to you to try to understand what happens. Here. If you increase the supply of money, if you increase the loanable funds, that will cause the quantity of money increase. That will cause the money supply increase. And of course, too much money in the economy will reduce the interest rate, The interest rate will fall down. So in here, I want you to draw one thing in your minds, one relationship between inflation or the value of the money and interest rate. So if money supply increases, that will cause inflation to take the place. And interest rate falls. So this is the relationship, you can see it. Money supply increases, the value of the money deteriorates, depreciates. That is, there is inflation, the interest rate take the place down actually. This is how the relationship is drawn between money supply, inflation, and interest rate. So why you need to know? Because when you hear from the news that the central banks strengthen the interest rate. So if the interest rate increased, what happens? Let's say interest rate increases. The government, the central bank decided to increase the interest rate. What will happen to, what do you not will happen, but what do you expect? It's just expectation, guys. It's just, you think that the way it will go. It's a theory, but how it goes in reality, it changes from country to country. But expectation from the finance perspective, from the assumptions, is here. Reducing the interest will cause money supply go up and you will create inflation. So what do you expect to happen? Inflation will take, what will happen to inflation if interest rate is expected to grow up?
It will decrease.
The inflation goes down. Inflation goes down. So the money supply will be reduced. So this is how you should understand the logic behind this. So coming to the Kazakhstan case, the national currency is depreciating. National currency is depreciating. Tenge. Okay. It depreciates. It falls in value. It was 400 and, sorry, it is now something 425 tenge for $1. But before it was 380. So it depreciated. It depreciated, okay? It lost its value. Kind of, it created inflation. So if you try to see, if you try to measure what happened to the interest rate, at that time, you would see that interest rates fall down. So when it was 380 and when it reached 425, and try to find out, if you want, you can search it and investigate, you could see that the country interest rate falling down. Country interest rate falling down. And the same thing with the Turkey. The Turkish lira depreciated a lot.
So now it's 8.2 liras per dollar. It's like
Yeah.
record.
Yeah, it's a very high record. But it is bad for the domestic people, but it's very good for the foreigners. Why?
Because they can get more liras at this rate.
Yeah, they can buy more liras, which at the end will make them to buy more goods and services before that they used to buy it.
Professor, what is Turkey doing to fix this thing?
Actually, the problem is that why they're letting, for example, they could keep the money, they could keep the money, the currency exchange rate stable. They actually allowed to depreciate. They allowed to go. They kind of expanded the corridor. Okay, there's a corridor for the currency exchange rate. If the currency could go like this, but if they increase the corridor like this, let's say let the lira be more than 8, and it could go like this. They do it with the one purpose, to attract investor capital flow inside of the country, because they're experiencing a bit kind of crisis. Not only the Turkey, but all the emerging countries, they're really experiencing bad situation now. Not because of the COVID, there are other factors that contributed to this issue as well. To make the falling soft, imagine the plane is about to crash. Would you wish the plane to crash hardly or with a soft, with a pillow? They kind of created pillow for themselves, the Turkish lira. So once they depreciate the Turkish lira, they attract the capital inflow. And one reason to attract the capital inflow from abroad is to pay the external debts. Imagine what happened in, remember what happened in Greece. When the time came to pay their debts, the external debts, they couldn't find any ways to attract the money to the country to pay the debts. They could not depreciate their own currency because they didn't have their own currency. They canceled out. They moved to the euro. They don't have anything. So that's really put a big pressure on Greece. Same thing other countries of the Europe as well. So when you don't have your own currency, it is really one of the big pitfalls. Okay, it can be one advantage, like you're in a Eurozone, you're kind of, we don't have any custom unions, you don't have any custom barriers. But on the other side, if there is crisis take the place, for you to come out from your, what do you say, from the crisis, do you know that the aggregate demand, we said at the beginning, let me change the color is really, So we said that aggregate demand is equal to GDP, if you remember from economics. For the government, it is the most crucial part, the aggregate demand, because it's directly represents the GDP. And it is the consumption, investment, government spending, plus net export. Export minus import. So to increase the aggregate demand, the economy or the countries, they cannot always play out with this form, with this interest rate, increase, reduce, or provide the loan to the guys. If one guy is defaulted on the loan and he lost everything, believe me, it will be very difficult to convince this guy to take the loan again. He will not take. So how would you stimulate it, aggregate demand? The research says that the only factor in the countries is the most contribution, is that plays the most contributing power is the net export, if you compare to government spending, investment, and the consumption. It is very difficult to change, to affect these three components, to make the aggregate demand to increase. Through the net export, they are doing it, and it works. UK, other countries, Turkey, and so on. Even the Kazakhstan, Kyrgyzstan, and Azerbaijan, they're all doing through the net export. How do they do it? The more the money, the more they export, the more money they will bring it to the country. So how they will export more? It can be services, it can be products, any products. So they will do it through the currency, through the domestic currency. Okay, do it through the domestic currency. If the value of the domestic currency depreciates, that means the people with the dollars, they will come, can buy, they will come to the Kazakhstan, and now they are able to afford more good services they could do it before, actually. So this is really an important point. When you see in the country a depreciation of the currency, what I noticed that domestic people, some domestic nations are starting blaming the government, but they don't know the logic behind of depreciation of the currency. If they didn't depreciate the currency, the fall from the crisis, the fall will be very hard. You will crash it, like the Greece, the crisis took place in the Greece. They didn't have their own currency. They could not depreciate anything, and they really had a big issue. And still they're trying to come out from that big problem that they faced because of the domestic currency, because they couldn't attract more money. So depreciating your own domestic currency helps you to attract more money into the economy. But as I said, US and other developed countries, they work to stimulate these three components like government spending, investment, and consumption through the monetary policy, like open market operation, discount rate, and reserve required ratio. It might work in a developed country, but nowadays, even in developed countries, it doesn't work. Take the Eurozone. Some of the Scandinavian countries, they have negative interest rate. Negative. Okay, it falls. This interest rate fell below the zero. Okay, it means they have nothing to reduce of the interest to attract more money, to attract more borrowers, because the borrowers, they don't want to borrow anymore. Potential borrowers, they're fed up of it. I mean, they cannot motivate the people to consume more. So it is believed that net export is one of the ways to attract more capital, to increase the money supply in the economy. Why you need to attract more capital? To pay the external debts first. Second, to stimulate the people to consume more. Otherwise, you're in a big problem.
But to whom Turkey owes money? To what country?
Actually, basically, they're big organizations like World Bank and IMF, they lend the money, but the Turkey has paid all the debts to these big organizations. However, they own to foreign big companies, the foreign financial institutions, like domestic private companies, they borrow the money from abroad. Okay, not the government itself, they owe the money, but the domestic companies, the private companies, they owe actually to the foreigners.
Okay.
Okay. Like Kazakhstan borrows the money from IMF, World Bank, if you talk about the external debts, and some financial markets, like issuing the bonds and so on. Okay, increasing demand for loanable funds. If you increase the demand for loanable funds, if you create more borrowers than suppliers of the loan, that will cause the interest rate to go up. Okay, the most widely recognized successful implementation of monetary policy in the United States took place in 1982 during the anti-inflationary recession caused by Federal Reserve under the guidance of Paul Volcker. The more recent example of the expansionary monetary policy, like pumping up the money into the economy, took place in late of 2000 during the Great Recession, like dot-com recession. As the housing prices began to drop and economy slowed, the Federal Reserve began cutting its discount rate from 5.25% in June 2007 all the way down to the 0% by the end of the 2008. With the economy still weak, it embarked the purchases of the government securities from 2009 until you remember when they purchase securities. What does it mean? It's an open market operation. In 2007, at the beginning, they used the discount rate to motivate the people to buy, but now they're using open market operation because discount rate was not that much efficient, and they decided to go with open market operation, which is buying securities, the government securities from the market. So for the total, and from 2009 to 2014, and the amount reached like almost $4 trillion. However, this did not work well. And recently the Trump was saying like, we should move to the negative interest rate. We should move to the negative interest rate. And this is how it works. Trump believes that the negative interest rate policy might work to stimulate the consumption to work out. So empirical evidence of the Fed's influence, the period of expansive monetary policy, which is associated with this strong performance of the stocks, where the period of the restrictive monetary policy generally coincide with a weak, strong performance. So small cap companies are more sensitive to the changes in monetary condition than the large companies, because large companies, they're already grown up large, and changes in monetary policy doesn't have any effect on the big and large corporations. But the small enterprises, they are really more sensitive to that. Cyclical stocks have much higher sensitivity to change monetary policy, so rather than the defensive stocks. And US monetary policy has got important influence on actually in the global markets, mainly on emerging markets. So interest rates and net worth. Financial institutions are exposed to the risk due to the maturities mismatches between the assets and liability. You borrow and you lend it. The money that you borrow, let's say 3 years of the maturity, the money that you lend it is 1 year. Any changes in the interest, it really causes a big loss or big gain for the financial institutions. So Fed is the US central bank, like we have in Kazakhstan, National In Turkey, Halyk. In Cyprus, National Bank. In Greece, National Bank. And in Europe, European Central Bank. So these banks are really existing to stabilize the economy, to keep the economy in stable level, and to control the money supply through the open market operation. And the action of the Fed in December 2000 in response to the economic crisis, the target rate between 0 and 1/4%. So this was the trying to get to this level.
Professor,
So,
isn't
yes.
it Turkish Bankası, which is National Bank of Turkey?
No, Turkish Bankası, it's a private bank. It's a private bank.
Okay,
It's a private bank. It's not national one. It's not the national ones are the Garanti, Halyk, Halk Bankası. They say Halk Bankası.
Okay, never encountered, by the way.
Okay. Sorry, you said what?
Never seen it in Turkey.
Because they don't have too much branches. Like in each city, they have one big Halk Bank, and that's it. They don't serve the people, basically.
Okay.
Okay. Central bank and the interest rates. The target is primarily the short-term rates. They focus on the Fed funds rates in particular, concerning the Federal Reserve System. Interest rate changes and volatility increasingly transmitted from country to country. And statements that is taken by the Ben Bernanke, it was the previous head of the Fed, can have a really dramatic effect on the world interest rate. And of course, it will affect the economy itself. In particular, we concentrate on 3 ways, like model that measures the assets, liability, gap exposure. Is first is repricing gap model, the maturity model, and the duration model. These models are used in order against any interest rate changes in the financial market, because if interest rate changes, it causes the bank to have a loss, and if the bank goes into bankrupt, definitely it will affect the whole system of the finance. And if all the financial system is affected, this will affect the whole economy itself, because the financial system of the country is it's a blood vein. Repricing model, which is funding gap model, repricing model concentrates on the impact of the interest rate changes on the financial institutions' net interest income, which is the difference between financial interest income and interest expense. Because of its simplicity, most of the small financial institutions use this model to assess their interest rate risk. So the major weakness of the repricing model is that it uses the book value instead of the market value. The maturity brackets of the commercial banks that they should always report of the repricing gaps for the assets and liabilities are listed here, like 1 day, more than 1 day to 3 months, more than 3 months to 6 months, more than 6 months to 12 months, and more than 1 year to 5 years, or over the 5 years. So these are the brackets that the financial institutions or commercial banks, they follow, and they report always their balance sheet. So under repricing gap approach, the bank reports the gaps in each maturity bracket, calculating the rate sensitivity assets and each liability on its balance sheet. So rate sensitivity here, we mean that asset or liability is repriced at or near current market interest rate within the certain time of the horizon. So we are given example in here, like 1 day, the gap is this, the pricing gap example. So asset is $20 and $30. As you can see, the amounts in 1 day, the gap is -10. 1 day, 3 months, -10, -15, +20, +10, and +5. And cumulative gap as you go, as you can see at the end of the 5th year, it's 0. So minus 10, then again minus 10, minus 20, then minus 15, it will give you minus 35. Plus 20, it will be minus 15. Plus 10 will be minus 5, and plus 5 will be 0. So applying the repricing model is change net interest income is equal to gap times change in interest rates, or it is the same like rate sensitive asset minus rate sensitive liability times change in the interest. So change in the net interest income in the sums, I represent the number of the years, okay? The number of the buckets maturities which is provided basically by the banks. Gap I, dollar size of the gap between the rate sensitive assets and rate sensitive liability in a maturity bucket I, and change in the level of the interest rate. So the example given in here, 1-day bucket gap is 10 million, minus 10 million. If interest rate rises by 1%, change in the net interest income, you will see what happens. This. So if you have a negative gap interest, so you are exposed to increase of interest rate. So you're afraid that interest rate will increase. If it increases, you incur the loss. If it falls down, you make a profit. So that's why, and it's simple to use it. And small financial institutions, they use it because of its simplicity to assess. Example 2, like 1-year gap. So 1-year gap you're using here. In 1 year, we take into consideration the cumulative one, okay? Because we need to take into consideration the cumulative one. Because up to 1 year, whatever is included. 1% increase. Still, if it's a negative gap, any increase in the interest rate will cause the financial institution to incur a loss. So rate-sensitive assets, example from the hypothetical balance sheet, like short-term consumer loans, if they repriced at year-end, would just make 1 year cutoff. 3 months T-bills repriced on maturity every 3 months. 6 months T-notes, they're repriced at maturity of 6 months. And 30 floating rates mortgages, their price rate every 9 months. So this thing you should keep in mind. Like, but in the question it will be given like which type of asset is when repriced at what rate and in which months. Rate sensitive liability buckets in the same manner as rate sensitive assets, so demand deposit and passbook saving, account warrants and special mentions, generally considered as a rate sensitive, insensitive, act as a core deposit, but there are arguments for their inclusion as rate sensitive liability. So some financial institutions, they're still, they say we should take it as, so demand deposit and the passbook saving, they are not rate sensitive, which is they are not repriced every year or every specific period of time. But some of the financial institutions says they need to be repriced because we need to consider them as rate sensitive assets. So the example is here, like 1 short-term loans, 1 year maturity, 2 year maturity, 6 month treasury notes, and so on. Equity, capital, fixed demand, so on. So may be useful to express the cumulative gap in the ratio form as cumulative gap divided by asset. It actually gives us a direction of the exposure and the scale of the exposure. Like 50 million over 70 million. It shows us 0.56, which is 5.6%. Equal rate changes on sensitivity on rate sensitive assets and rate sensitive liabilities. Like example given here, if 2% increase in rate sensitive assets and rate sensitive liabilities, the expected annual change in net interest income will be the following. We're using cumulative gap, which is 15 million, assuming that it's 50 million times 0.1, which is 150 million. So with a positive cumulative gap, rates and net interest income, they move in the same direction. So there's a positive relationship. So financial institution in this case is exposed to negative changes in opposite. If the interest rate goes in opposite way, if it goes down, then it will take down the income of the financial institution. Unequal changes in rates, but it's with the assumption if the rate sensitive assets and rate sensitive liabilities are repriced at the different rates, okay? At the different, if interest rate changes in sensitive assets and sensitive liability differently, then the change in net interest income is unpredictable. So example is here. If rate sensitive asset rises by 1.2% and rate sensitive liability rises by 1%, then change in net interest income will be 310. With the example, if rate sensitive assets 155 million and rate sensitive liabilities 155 million. If rate sensitive assets changes is less than rate sensitive liabilities, change in net interest income will end up with a negative gap. So financial institution can restructure an assets and liabilities or some off-balance sheet items, because in balance sheet we have not only the on-balance sheet items, we have off-balance sheet items, but they're very important as well. When we come to the off-balance sheet items as well in the chapter, we will see why they're important, because measuring the liquidity issue, when I say liquidity, could you just give me reminding what was the liquidity? How do you define the liquidity?
It's the ability to pay off short-term liabilities in cash.
Yes. You're trying to see whether your current assets are enough to cover your current liabilities. However, if you're really expert, it's not enough to measure just current assets and current liability. You should go for the off-balance sheet. You will see that your off-balance sheet items are even higher than any of your current asset or current liabilities. You may have an off-balance sheet asset, you may have an off-balance sheet liabilities. These things you should take into consideration in order to calculate the liquidity position of the financial institution. But not in this chapter, but in the later chapter that we're going to introduce. So positive gap is an example of given here. Rate sensitive asset is 500, rate sensitive liability is 400 million, and the bank has got a positive gap of $100 million. If interest rate increases, the bank net interest income will go up. If interest rate falls, the bank net interest income will go down because the interest revenue from asset drops by more than interest expense that is coming from the liability part. The bank with a positive gap will lose net interest income if interest goes down. If it's not positive gap, if it's a negative gap, then opposite. So restructuring the gap. Example of Harleys Wheel Saving Financial Corporation at the end of 2008, like 1 year gap ratio, they had it 1.45%, and 3 year gap ratio was 3.97%. And if interest rate rose in 2009, they would experience really huge increase in their net interest income. However, what happened in the 2009? What happened to the interest rate? What the Fed done, if you remember, they reduced from 5% to 0. Why they did so? Why the Fed decided to reduce the interest rate from 5 to 0? Not exactly 0, but close to very 0. Any idea? Why the government or economy or central banks, they reduce the interest rate?
Maybe to increase spending?
Yes, very true. To increase the spending, to increase the demand. However, when you increase the spending and the demand for the people, on the other side, like Harleys Wheel Saving Financial Corporation, they incurred a loss instead of a large increases in their net interest income.
Did the government then save this bank because it was their fault?
It's not their fault. You know, guys, you have to wait very carefully. You know the economy is about to collapse. You know this bank is already about to default. And on the other side, the people will suffer and the economy will be collapsed. So you make a wait, you just say you go to compromise, like some banks are went to default, they want to bankrupt, but the bank did, the central bank did not make it intentionally to collapse, to make the banks to go bankrupt. They made it with the intention to, the main purpose was to save the country, save the economy. Otherwise, they could have ended up really like in 1930s, what took the place, the Great Depression. They didn't want this thing to happen. But however, in some countries, it was the same scenario. Like the people, they lost their jobs, people lost their houses, and they were, literally speaking, they were lying and sleeping outside in the country. And they were begging for food, they were begging for money, and so on. Zero interest sensitive gap if the interest sensitive asset and liability of the bank are equal, and the bank is relatively kind of isolated from interest rate risk. So kind of they hedged themselves against any volatility in the interest. So in this case, interest revenue and funding costs will change at the same rate, and the bank's gap is zero. This is actually the goal of the financial managers in the financial institutions, to make the gap close to zero. Aggressive rate sensitive gap management. Here we are given like expected change in interest rate, like when it's a positive, when it's a negative, we already talked. When it's a positive gap, when interest rate rises, you try to increase in interest rate in asset and decrease in liability. When the negative gap, you try to reduce the interest in asset and increase interest in liability. So this is how you use this strategy in a financial institutions. As I said, the repricing model is very useful and is very easy to use. However, it's got some pitfalls. One of the pitfalls, it ignores the market value of the effects of the interest rate changes. So it aggregative, its distribution of the asset and liability within the individual bucket is not considered. Mismatches with the buckets can be substantial as well. It ignores the effect of the runoffs. The big corporations, big companies like financial institutions, they do not use this repricing model. Only the small ones are really getting some benefit of it. And off-balance sheet items are not included. Hedging effects of the off-balance sheet items are not captured, like future contracts, forward contracts, options, call options, and letter of credit. Many of the off-balance sheet items, they're not considered in the repricing model. Okay, I'm done for the lecturing today, but I want you to do something now. We have 25 minutes. In 25 minutes, please find news related to negative interest rate policy. Okay, negative interest rate policy. I will create an activity there. You will upload your answer there, but do not upload the copy paste. Just in your own words, try to explain what does the negative interest rate means and why it is used. Negative interest rate. I will create the activity there. If you have any questions, please feel free to ask now. If not, you can start doing searching. I'll stop sharing.
Professor?
Yes.
So we need to write like the meaning of negative interest
Yeah,
rate
what
policy,
what did you find it about the negative interest rate policy? Meaning, and
okay.
give the example. Which country
Okay.
use it? in your own words. I'll create the activity now. You will just upload or just type it in that activity. It's activity, I think 7.